Oh, hi, bonjour, welcome everybody. My name is Milena Odino. I am the Business Information Officer here at the World Trade Center, Winnipeg. I would like to begin today's webinar with our land acknowledgement. So we acknowledge that we are gathered on the lands of Treaty 1 territory and that Manitoba is located on the traditional and ancestral lands of the Anishinaabe, Anishinaabe, Denessalian, and Dakota Oye nations. We acknowledge we're also on the homelands of the Red River Métis and that northern Manitoba includes lands that were and are on the ancestral lands of the Inuit. So the World Trade Center Winnipeg team respects the treaties that were made on these territories and acknowledges the harms and mistakes of the past and present throughout our nation. So thank you for joining our webinar, Comprehensive Insurance Solutions for Your Business, Life, Critical Illness, and Disability, which will be presented by Daniel Billinkoff of Pereux Insurance Planning Incorporated. Before we begin, I just want to share a few housekeeping rules and items. So number one, please send all your webinar questions directly in the chat box at the top of your screen, and we'll try to answer as many questions as we can. We also have a Q&A session at the end. Number two, please send any logistical questions in the chat box, and I will try my best also to answer as soon as I can. And lastly, you will receive a PDF copy and a recording of this presentation within the next week. So now it's time to start our webinar. I would like to introduce you to Daniel Billinkoff. Daniel is a life insurance advisor with the family-run firm of Pereux Insurance Planning. Daniel assists business owners, incorporated professionals, and families with all sorts of life insurance and living benefits planning. Prior to joining Pereux over 4 years ago, Daniel was a self-employed copywriter with experience also as a writer and communications officer. So welcome, Daniel. The floor is all yours.
Awesome. Well, thanks for the intro. Thanks for hosting me and for, letting me speak on some things that we feel are very important. I know you've agreed, so thanks for coming today. So I'm going to jump in just a presentation. You can see my screen up here. All good?
Yes, now we can.
Okay, perfect. Yeah, it might be a little bit of lag. I'll try not to break however Teams works. I'm usually on Zoom, so I was very nervous about getting all this shared, but it looks like everything's working pretty well.
Yes, it's good.
As far as what I'm going to speak on today, I'm going to just do a quick intro to our team, explain who we are, what we do. We're going to talk about corporate life insurance needs. So different reasons business owners use life insurance for protection, for wealth building, wealth preservation. We're going to talk about critical illness insurance as well. So this would be one of the living benefits products that we work in. I'm going to talk about disability insurance, the importance of it, what to look for in terms of coverage and a policy. And then I'm also going to touch briefly on private health services plans, which is not quite an insurance product. It falls a little bit under the benefits kind of umbrella, but it's applicable, especially in the small business owner market. So as far as our team goes, this handsome group, that is our advisor team. So we also have a great administrative team behind the scenes. The gentleman on the left, so Pereux, that is my father-in-law. He started our business 50 years ago, so just over 50 years ago. He's been in the business for a very long time. His daughter, Pereux, has taken over the reins of the business. She's been in the industry for about 15 years. Previously worked as an addictions counselor and in the mental health services world. She grew up in this industry and loves it and has become one of the most respected advisors across Canada in her field. That's myself. I'll do a little quick intro to me afterwards. I usually do more question asking than talking about myself or our business. So this is a little out of the ordinary of what we do. And then Nancy Arundel grew up on a cattle farm in Wawanesa. She is our product expert, so she does all of our advanced planning and analysis of different companies, products, and everything like that. Personal corporate life insurance, disability, critical illness insurance. We also have a group benefits wing, and we have a sister company that deals in the world of wealth management. Okay. We're independent brokers, so we work with all the insurance carriers where you're in between yourself and the Sun Lifes, Manulifes, Canada Lifes, Equitable, all those companies. We have access to RBC, etc. Tons of team experience, and we work with our clients for the long term. Our real core market is business owners. And we have clients where someone comes to us and says, "Hey, I'm starting an ice cream store. I think I might need some benefits." And we have clients who have run some of the biggest manufacturing, agricultural businesses in Manitoba, and they're looking to exit. We deal with everything in between. So helping with growth, launch, and then ultimately, when our clients are looking to exit, helping them maximize the value that they can get through proper planning. Who am I? That's a very existential question. I love what I do. I love working with business owners, entrepreneurs. I come from a communications background, so I'm a creative communications graduate. I have two teenage girls who are probably over one of my shoulders here, pictures. So that's a full-time job on a side. Fitness and music are, I would say, the two personal passions that I have outside of work and family. Why does any of it matter? Why should you listen to what we do or say? This was a quote, actually. So this came up. So my father-in-law, he's been in the business for 50 years. We've delivered a lot of checks over the years, and helped a lot of families. And this was actually a quote that came up for a personal case where it was his best friend, so his high school friend, who passed away tragically in a camping accident. He drowned in Alberta. And we were just talking about them, me and his brother, so my uncle, were just talking about this family, and the truth is that the money saved them. So the insurance policies that we put in place absolutely saved their family. The thing that I'll say about the work that we do is that if you meet with any of us, you'll see that we care very deeply about what we do. We can't solve every problem in the world. So if someone passes away, there's the emotional toll. There's so much that gets lost. Money won't solve those problems, but it'll solve your money problems. And that often, whether it's in a business or a family, so much about losing someone, it does hit in terms of the financial side. So that's really where we work. Life insurance has been around for hundreds of years. Different people have different thoughts on what it is or what it means. We talked briefly about some just cultural, some cultures don't believe in life insurance. All it is guaranteed cash. So instant tax-free liquidity when you need it most. So in a corporate setting, can be very beneficial, as well as obviously in a household, for personal reasons. So why am I here today? Really is just, empower, educate, and just give you an idea of, maybe some steps that can be taken to protect your family, protect your business. So I'm going to jump in on the life insurance side. So I'm going to talk about corporate life insurance. So when we're talking about corporate life insurance, we're talking about corporately held policies on the lives of either the business owner or key employees to really, create continuity in a business should something happen. So I'm going to go through them. The first one, so this is a very common, startup business need. So starting a business, maybe there's two partners. I'll use the example of maybe an engineering firm. So you have two key partners. Maybe one's stronger on the sales relationship side, the other one's stronger on the actual work that's being done. They're both essential to the business. If something happened to one of them, then not only is there a loss to that person's family who passed away, but to the business and the employees of that have survived in the business, it's a huge loss, and it can be a huge financial loss. So in replacing the income generating abilities of someone, key person life insurance is a great way to get this done. So whenever we're talking about insurance, life insurance, really there's a few ways you can protect against the loss of someone. You could try and save up the money to do it. So let's say you've assessed, Nancy, who works for us, for example, she's been with us for I think close to 25 years. She deals with our clients one-on-one. She has knowledge that the rest of us don't have in terms of the products. So she is absolutely essential. And there's ways that you can calculate. I'm not going to get into numbers of things today, so I'm not going to get into the nitty-gritty of numbers. That's an individual case-by-case basis. But if something happens to Nancy, then, we're all screwed. So that's the insurance need. Um, you could try and save a bundle of money as a just in case, but it's hard in a business to keep cash on hand. You could, sell off parts of your business to try and, create a pool of money, but who wants to be moving, selling, doing things like that to fund, this need if someone passes away? Um, Life insurance is another way to do it, and it's just, from our experiences, the most economical way to just create that money when you need it. Buy-sell life insurance. This has to do with your shareholders agreement. So if you're a business owner and you have multiple shareholders, whether you're siblings or your friends or your strangers who have just come together to start and open a business, you should have a shareholders agreement. And part of that includes the buy-sell provision. And this is almost like the thinking of, if you're going to think in a personal standpoint, this is kind of like the types of stuff that would be in your will, or even deeper, that might be in like a prenup agreement on the personal side when it comes to marriage. When you're business partners, you're basically married. You're attached together. If one of the partners passes away, then the surviving partner is going to want to look after the family of the deceased like their own. Going to want to make sure that they get essentially what they deserve from the hard work of their spouse, who's been running the business. So the easiest example would be, insert type of business here, but you have two shareholders. Let's say the business has grown, it's now worth $10 million, and one of them passes away. Their shares are going to, hopefully, as your agreement should state, be bought out by the surviving shareholder. So if you're both 50-50, shareholder A passes away, shareholder B should have the right to buy out the shares of shareholder A. I work with my spouse, so Leanne Pereux is my spouse. So in this case, it would be fine to have your spouse as your new business partner. I would just slip in there and not be as good at her at anything, but at least I would be serviceable. In most cases with business owners, they want to be partners with this person, not the spouse. Okay? And the spouse doesn't want to be running that business. What the spouse wants is the value of those shares. How are you going to find, in this case, $5 million to buy out the spouse? Most businesses, even successful ones, aren't sitting on a lot of cash. So same idea, you could borrow, you could sell. Not the best case scenario for the surviving shareholder or the employees in terms of continuity. You're already going to be going through a horrendous situation. So having proper life insurance on the partners will ensure that if one of them passes away, there's the liquidity and the process that's outlined in the agreement to then buy out the shares, so that partner A, the surviving shareholder, can then be the 100% shareholder of the business. There is all sorts of different ways to structure these types of policies. Our recommendation in most cases is going to be term insurance. I'm going to talk about the types of insurance later, but whatever the lowest cost way is to achieve these goals is the way that you would want to do this. So when you're working on a shareholders agreement, if you're working with your lawyer, if you're in that startup phase, really the things that the buy-sell provision are going to outline, amongst a number of other things, but the things that we look at when we look at our clients' agreements are what happens when a shareholder dies, who's the agreement between, is it between individuals, are the shares owned in respective holdcos, is the agreement between the holdcos, and is there life insurance outlined in the agreement? There often is. So it'll say in the agreement, you should have an adequate amount of life insurance in each partner to fund the agreement. Lots of times lawyers will put this in place. The business owners will sign it. This is on the laundry list of things that you needed to do when you started your business, amongst a million other things that were all challenging. So lots of times the agreement will just get signed and then no one deals with the actual funding with the life insurance. So that's often something that we will discuss with our clients and unveil. There'll also be some different things outlined in terms of what happens if a shareholder is disabled. So these are things to think about. If your business partner had a stroke and could not work, at what point would you want or need to buy them out in order to keep the business going? How will those funds be found? And ultimately, if there is life insurance on the partners, one of the big questions is what happens if one of the shareholders exits? Who has the rights to the policy? And are these types of rights laid out and clear? So those are all important parts. I see some heads moving around like this on my screen. All good.
Right, that wasn't for you.
Okay, no worries. All good, just checking. Business debt protection. So I'm outlining 6 corporate life insurance needs. This is number 3, just so you can get an idea of how much life insurance talk you're going to hear. Business debt protection. This was fairly standard. So, if your business takes out a loan from the bank, they may require a policy so that if, you were to pass away, that the loan could be called. You should have, when I talk about these different insurance needs, key person, something for your buy sell, oftentimes, it could be one larger policy that's achieving multiple needs. If it's needed for business debt protection, the best way to do this, the safest way is to, usually the bank will ask for it to be assigned. So your corporation will own the policy, will pay the policy. You as a business owner will be the insured. The policy will then be assigned to the bank, meaning that they're the first payer. So as you pay down your debt, all that the bank gets is the portion of that policy that will pay off the loan. So we have seen in some scenarios where, for whatever reason, the corporation, so the owner was told to make the bank the beneficiary of the policy. That is not proper. That is not how it should be done. It should be assigned, which is different. If the bank was the beneficiary and you had $1 million policy on your life and you pay down that loan and now you only owe 250, well, 250 is what the bank should get. If they're the beneficiary, then that check is going to get written to them, and it's going to cause a pretty big headache for either remaining shareholders or your spouse to work through. A lot of the work we do is in rural Manitoba, and a lot of it has to do with family businesses, whether it's on a farm, manufacturing, whatever it might be. And a common scenario that we see is, families who own very successful businesses. They've had, 1 or 2 children step up and really be integral to the business and prove themselves and show that, they are going to take it over and run it, and this will be the future of the business. Just for working myself in a 2nd-generation family business, that is the dream scenario, is that you build something over decades. You pour your life into it, and if it all makes sense financially, that your children can then take the reins and run with it. A common scenario, whether it's just lack of interest, capabilities, disabilities, any number of reasons, is some children want to be involved and some children don't. So a common scenario we run into is that the business owner wants to leave the business to one family. It's worth a couple $1 million, whatever it is, but they're looking for a mechanism, preferably using corporate dollars, because everyone likes using corporate dollars when possible, is to help with that equalization. And when we say equalization, equal is not the quite word, it's fair, but fairization is not a word. So it's really a state equalization. And what that means is the kid that's taking over the business isn't going to get the business. So let's say it's worth $2 million, $5 million, whatever. They get the business. I mean, they're not getting $2 million or $5 million. They're getting a lot of stress. They've put a lot of sweat into it. They've probably taken a few years off their life working with their parents for a decade to build the business. So yes, they're getting a great asset in terms of, helping their future, but they're also not getting a pile of money. So whatever the owner of the business, the generation, 1 or 2, whatever it might be, thinks is fair, life insurance is a great tool to create liquidity to go to the other child. So child 1 inherits the business, child 2 gets $1 million or whatever it is, tax-free, guaranteed, and nice and clean. So everyone, when they're sitting around the, Christmas table or Passover Seder or whatever it is, where your family, gathers, they aren't talking about, when are you going to sell this business so I can get my money. And the reality too, especially Manitoba, when it comes to, if you're owning land, if you're owning real estate, if you're owning farmland, especially, is that all of really the value is tied up in the assets. So there isn't that liquidity. Even if you've inherited a $5 million farm, it doesn't mean that you're living the life that maybe your siblings would expect. You're grinding it out. And, this is a way to kind of get it done and pre-fund it. Funding future tax liabilities. So there's a lot of talk when, especially around a lot of these capital gains inclusion rate changes. You'll often hear people talking about, those family cabins, so the non-primary residence, so those secondary homes that trigger capital gains on death. So, you can pass to your spouse and get a rollover, but if you want to leave something, a value that's grown in value to the next generation, your kids, your grandkids, is going to trigger capital gains, and very problematic when it comes to, families who have, they bought a, family cabin for 100 grand and now it's worth, 1.1 million, or I'm just using easy round numbers, and you've seen $1 million of growth. So on death, passing it down, you're looking at capital gains, hit of, $250,000. Where do you get that money? So life insurance has always worked. Permanent life insurance is a way to pre-fund essentially future tax liabilities. I know the capital gains exclusion rate, bump is on hold or is ended, and it wasn't on hold and it was going to go, and now it's, been canceled. But I think we can all expect that capital gains are going to increase, taxation on capital gains will increase in the future, as all taxation seems to increase in the future. And when you're looking at things like share value, so passing business shares down, over and above using your capital gains, the exemption room, there's often a big hit, so a big tax hit. If you've grown a successful business, then you probably have a great tax accountant or tax lawyer. Your tax accountant can, at most cases, give a pretty good idea of your capital gains, your tax exposure. That's a conversation we'll often have with our clients' tax team, and a lot of our clients will choose to pre-fund using, corporate dollars, that pool of tax-free money that can be pulled out to fund those tax needs. And then kind of the last area, where life insurance is used is, and in this case, we're really talking about corporate life insurance. So that's what I'm talking about today. This is corporately owned life insurance for corporate tax and estate planning needs. A lot of corporations. So when people think of, if they're fully removed from the business world, they think of corporations as like, oh, a corporation's like IKEA or something like that. So if someone says, oh, I own shares in a corporation, they think, oh, wow, yes, it's an operating company. A lot of clients will have, obviously a corporate structure. They'll have a holding company that owns real estate or owns shares in another business. And, and it's really there to help save on taxes. So if you don't need it on your pocket, you can keep in your corporation, bring it in at a lower tax rate and grow it, in a really, tax favorable manner. On death, those assets will then be in a corporation, whether it's your investment portfolio, it's the buildings you own, whatever it might be. And, you're going to leave those shares to your children eventually, to the next generation, and shares of that company that then has these assets. Well, we kind of look at that as a good problem. So they are getting that value, but to pull it out of a corporation, you're going to have to pay a dividend, and all of a sudden those corporate assets start to get eroded. So that corporate, even with having a great tax team behind you, doing all the things they're supposed to, there's still going to be some estate erosion just due to the fact that to get that asset out, there's going to be some dividend tax being paid. So corporate life insurance, a lot of people don't know this. We've been in meetings where they say, yeah, okay, I have $1 million of life insurance that's going to pay into my corporation. That's fine. But then, my husband's or my wife's going to have to pay, give 50% of that back to pull it as a dividend. Well, life insurance proceeds, they pay into the corporation tax-free, and they trigger something called capital dividend account credit. So the life insurance proceeds get paid in. CDA credit is then elected from your accountant, and the CDA credit is what allows you to pull life insurance proceeds out tax-free from a corporation. So CDA, capital dividend account, is, if you think about with, say, capital gains and non-taxable part, really what you're getting is CDA credit. So the CDA credit allows you to pull money out of a corporation on a tax-free basis. And that's why life insurance works really well in a corporate setting when we're looking at what's sometimes called a corporate asset transfer. So I've got a little diagram here. We're brokers, so this is from Sun Life, so they've created this. I've pulled a few from different insurance carriers. So this top little section, I'm not so sure if you can see your mouse. Like I said, Teams isn't my best thing, but I'm moving my mouse around. I'm going to assume you can see it. And I'm moving it around the top portion here, where it's showing the traditional approach. So traditional approach is you have your corporate investment portfolio. There's going to be some tax on the income, so on the gains, and there's going to be some tax on death. So that has to do with the growth. If you want the money out during your lifetime, then you can pull it out. Like there'll be some, tax on there, but it's easy to access. So it's your corporate money, it's your corporate investment portfolio. On death, so when you die, essentially what you own will be considered to be liquidated. There'll be some tax on deferred gains, and most importantly, you'll have this money in the corporation in terms of investment portfolio. To pull it out, you're going to have to pay a dividend, to your estate. So when you're passing this down, so what you're going to see is your estate's going to get a good chunk of it, but a good chunk of it's also going to go to CRA. And we're not anti-tax. We pay a lot of tax. Everyone pays a lot of tax. If whether you're a business owner or not in this webinar, you pay a lot of tax. You pay enough. So corporate asset transfer, really what we're talking about is diversifying some of that portfolio. So some of the investment portfolio, we're going to move into a corporately owned permanent life insurance policy, a cash value policy, so like a whole life participating policy that has a investment fund that will help grow that policy. Okay, there's no tax on the growth within a life insurance policy as it's growing. The full proceeds pay out tax-free on death into the corporation. During your lifetime, if you needed that money, there are ways to access the cash value of a life insurance policy, whether it's via collateral loan, policy withdrawal. But really what we're talking about in this scenario is clients who maybe they've sold their business, they've had this money come into their corporation. They know they've got their retirement figured out, but they've got this money that they want to pass down and with the least tax exposure. So there are ways to access it during your lifetime, but really what we're saying is this portion that we're moving and diversifying into life insurance policy is for your estate, not for you. Okay. On death, your traditional investments work the same way, but the life insurance policy proceeds are going to pay tax-free into the corporation. The majority of them will be tax-free when pulling them out, so via CDA, so as a tax-free dividend. Some of that, so the closer you get to life expectancy, so for myself as a non-smoking male who's currently in his 40s, I won't say how old, but I'm in my 40s. My life expectancy is mid-80s. As I get closer, the gap of the chunk that is tax-free via CDA gets larger and larger. As in your life expectancy, it's going to be almost completely tax-free, if not fully tax-free, what you can pull out via the CDA credit. And really the end result is lower tax paid and more money going to your state. And we've helped clients make these calculations and figure out kind of what that difference is going to be. And it's a great way to just maximize what your family is getting. Life insurance is the tool, so it's just a vehicle to accomplish different goals. Whether it's protecting your business, it's funding a shareholders agreement, protecting its debt, or it's just passing more money down, generationally. The reason that it works well out of, the different tools out there for those needs is you're funding policies with corporate dollars. So better after-tax money to fund the policy. All the growth in these policies, even in a corporate setting, is tax deferred. So tax-free on death, but tax deferred during your lifetime. And life insurance creates capital dividend account credit. So just a great way to be able to maximize what actually gets in the pockets of the people you care about when it matters. Term insurance, I mentioned really there's three main types of life insurance out there. There's all sorts of structures. Term insurance, it's the lowest cost type of life insurance. 10-year, 20-year, or whatever, whatever duration makes sense for your business. We find when looking at, say funding a shareholders agreement, many businesses don't make it past 10 years. The longer the term, the more expensive the coverage. So we'll often help clients just figure that out. You want to keep your costs down in those startup phases. You have a locked-in rate for the duration of the term. Cancel policies at any time, and any term insurance is convertible to permanent in the future. Meaning if you have a 10-year term policy and you say, you know what, I like that other one you showed me, permanent life insurance, but your health has changed, you couldn't qualify anymore. Your initial term policy could be converted to permanent, whatever the rates are in the market in your current age, whatever the health style was when you initially put that term in place. Universal life is another type of policy, and really what we're looking at here is, so there's no steps in coverage, there's no expiry. It's a level premium for life is often the way we'll structure it, and a level amount of life insurance for the duration that you have the contract. So a really simple way to fund things like estate equalization, tax liabilities, where we know we want this amount of life insurance on death for these reasons, but we want to find the lowest cost that we can have that amount of, guaranteed permanent life insurance. There's other ways to structure it. There's additional, money can be put into these policies to pay them off sooner. Those are all just things that we help clients figure out for their specific scenarios. Whole life participating life insurance. So this is the other type of life insurance I referenced. A great tool for estate planning, for the asset transfer scenario where you're looking to grow, grow the amount of life insurance you have a cash value accumulate within the policy. So if you want to leverage against it, you can do that. A lot of our clients say, for example, in the real estate world, they know they want this policy. They know they want a certain amount of coverage because they have just massive capital gains exposure, and a lot of volatility in the work that they do just by the nature of the real estate world. Whereas they love the idea of something that really complements that with no surprises, very level, very even, when the world feels like it's collapsing, whether it's pandemic or it's this week, just with so much uncertainty and markets volatility. We like being in the life insurance business, not the investment business. Nothing's really moving or changing on our side. So for a lot of our clients, they love a policy that can grow, not going to knock the socks off anything, but it's going to be consistent and low volatility. But they also need cash in their business. Permanent life insurance policies like this, so a whole life policy with cash value, can be leveraged against. So a lot of our clients will say, I'll put this much in each year, but I want to be able to borrow that back. What can I get access to? And the reality is that lenders, if you're over the threshold, will usually lend somewhere in that 90 to 95% of your input, so your actual premium amount. So your insurance premium, they will lend that back to you for your own investment purposes. So you could pay your premium, borrow it back from a bank, invest it in, the equipment that you need to grow your business that you can get a return of X, Y, or Z. The policy backs that loan. So if you to pass away, pay off the policy, the remaining life insurance proceeds go to your corporation, ultimately the people that you care about. So there's, definitely leveraging going on these types of policies less than 10 years ago when interest rates were incredibly low and there were just a lot more incentives to do so. So that's kind of on the life insurance side where I'm going to stop and I'm going to move on to the critical illness insurance side. So critical illness insurance, it really came about, as a response to better healthcare. So it's a good news story. This is a product that's, 20 plus years old, but has got a lot more attention in recent years. 1 in 2 men, 1 in 2.2 women, Canada develop cancer in their lifetime at some point. Heart attack, stroke. The reality is that most people, if you're of any age are going to know someone in either immediate family or friend group who's experienced this. The good news story is that, due to advancements in healthcare, more people survive than they did in, previous generations. So 60% of Canadians diagnosed with cancer are expected to survive. Most people who have a heart attack and are hospitalized, so there's a proper response, survive. Same with strokes. Critical illness insurance is just a great way to protect yourself against these risks. And, I'm going to talk about disability insurance afterwards, but most, business owners, professionals, lawyers, doctors, not as much doctors, but professionals who have a heart attack, stroke, cancer diagnosis. I mean, it's your business. You'll keep working. So you're going to live, you're going to get treatment in most cases. And you're going to keep working. So you're not going to be able to necessarily go on disability, but there's going to be a very big disruption in your life, in your household. Getting any sort of test results that are abnormal is one of those worst case scenarios. Critical illness insurance just helps. It helps with the money side of that. So the way that the product works is there's a number of covered conditions. So most of the carriers have 26 covered conditions. If you're diagnosed, by a physician, obviously, with, one of the covered conditions, so heart attack is a very simple one. So you have a heart attack, it's confirmed by a doctor, and you survive the 30-day survival period, then you will get your claim. So clients will base the amount of insurance they need based on, usually we'll recommend a multiple of your income. So 1, 2, 3 times your income is how much coverage you should have. It's a lump sum tax-free benefit. So tax-free payout if you own this personally. You can own this in your corporation. I'll chat on this afterwards as key person coverage, but the money will flow in tax-free, but there's no CDA credit when it comes to critical illness insurance. So the money would have to be pulled out as a taxable dividend. So a lot of our business owner clients will own coverage personally. They'll also own some corporately. There's no limits or, there's no rules on what you use the coverage for. I talked about, just for examples of this. So this was actually, my, we've actually had a fair amount of claims in our family. My brother-in-law, so he had a stroke at 41 and young child, wife working full time, and just a horrible scenario. I mean, these are not good times in your life for your family, for your spouse, for business partners. Something like a stroke just changes the trajectory of your life. He's fully recovered. 5 years later, he had a really great, strong recovery and great doctors and everything like that. But in the hospital, my wife was there and he just said, this is the worst, but thank God for the CI money. And like I said, there's no limits on how you use the money. Use it for income replacement. You can use it for paying the bills. If your spouse, even if they have a great disability policy, they cannot take the year off as paid leave because their spouse had a stroke. So you're losing multiple incomes in a household. The money can be used however you want. They used it for some medical treatment, and the balance, they bought a cottage because they had a real bad year. So the money is just a way to, cover what's needed and then hopefully just bring a little bit of joy in a hard time. As far as who's making claims and why, the big four, so really where most claims are made are cancer, heart attack, stroke, and coronary artery bypass surgery. So this is where most claims are made. And interestingly enough, they're made through really all sorts of demographics. So most claims obviously are going to be made, age 40 and above. And I will say that I have a feeling that maybe some of these numbers are a little skewed in the sense of there's less people in their 60s who probably own these policies. So I wouldn't take these as exact representations of data. However, they're pretty spread out, and we've seen that within our own practice. You will see 0 to 24. So there's all sorts of ways to own these policies. So I'm just going to go back 1 second to this. So we own, for example, we own policies on our 2 daughters. Genetics in our family is not the best, not the worst, but not the best either. Sun Life, so that this chart is from Sun Life. Sun Life has an awesome CI product, so a youth CI product where age 25, if no claims are made, which is your goal and your hope, of course, then all the premium that's been put in from, we bought these, I think, when they were age 2 or whatever. So 23 years of premiums. At age 25, 75% of that is returned. So as, tax-free check. So you get the money back if you haven't made a claim. And then from age 40 on, you can cancel this policy. So your children could cancel the policy at any point in there and get all the money back that was put in. Or at age 75, it expires and get all the money back. So you can kind of almost think of it as renting policies. It's a forced savings tool, and it just ensures that, whether there's twists and turns through youth, through adulthood, in your health, that you're still able to get a policy like that. You can buy them on your kids. In a business, so as far as corporate critical illness insurance, key person, so same thing as with life insurance, someone is essential to your business and, something happens to them, that you are hooped. We have a lot of our clients who will own these types of policies, either on key people, so employees, or on themselves. I definitely recommend owning a policy like this on the shareholders in a business along with life insurance. You want to make sure that if something happens, you're not just left in the lurch, that your business isn't, it can keep going. And also that there is money in the business where you could, you have the flexibility to keep paying them, whatever it might be. It just creates the flexibility to make sure that their lives, your lives, the lives of your employees, your teams, your family, their family, things can continue as planned, which is our goal. As I kind of alluded to, there's all sorts of different contracts. There's, term insurance, there's permanent, there's return of premium. So there's different ways to structure this. And really, we try and just match, our goal is always just get the best product from the best carrier for really the cash flow of the business. What makes sense, what's the timeline where you need the protection, and kind of help sort through all of that. Different carriers are different in underwriting. So I talked about our business, what we do. We help our clients with everything. So we are their advisors from the start of saying, here's your risks, here's what your accountant thinks, here's what you should ask your accountant because your accountant hasn't mentioned anything to you or any sort of thoughts on long-term planning or risks. We do the applications with our clients for our clients. We don't work for the insurance carriers, so we then fight the insurance carriers to make sure we get the absolute best decision, underwriting decisions for our clients, and review ongoing just to make sure everything makes sense as the future goes on. Long-term disability insurance. So critical illness insurance covers things like cancer, heart attack, stroke. I think there's a bit of a misconception when it comes to disability, meaning, someone cannot work, physically cannot work, and their doctor says you cannot work because of A, B, or C. People often in their minds I think, go to injury. So they think of accidents. They think of more, what would you consider blue collar professions where a physical injury limits them from working. This does happen. So that makes up about 23% of claims. The majority of claims really do come in from what we've seen in our type of practice, which is a little bit less maybe blue collar and more disability insurance for business owners, doctors, lawyers, physicians. Mental health is where the majority of claims happen. So mental health, depression, anxiety, along with things like, cancer, things like that. But mental health is a big one, especially post-pandemic. Um, and physicians saying you cannot go back to your job, so you cannot work, and really common throughout all different age groups. So not in, it really doesn't differentiate. We have, for clients who are lawyers, doctors, um, disability insurance is it's a no-brainer. It needs to happen. You are your income. Same with, entrepreneurs, business owners, you are your income. If you're not doing your thing, your family is not paying the bills. You've invested time into a business, you've invested money into education, you've, put a decade of your life into becoming a physician. You need to protect that. Um, and this was a quote from one of our clients. She's on disability, partial disability, so she's a lawyer. This was a breast cancer diagnosis, surgery, recovery, was still working, so this was a partial claim. Most of her disability insurance, long-term disability insurance, is through RBC. And just with meeting her with her and reviewing, she just said, they've taken such good care of me, and I'm just so happy that we've done this. So got the policy in place, increased the limits each year to make sure that if something happened to her, that she would get, the right amount of income as replacement. And it's always great for us to hear how good the carriers are. So the RBCs, the, Canada Life, when it comes to disability products, IA, they will help you if you are disabled get, what you've paid for in terms of the coverage. They'll help figure out, what the best scenario is. It a partial claim? Is it a residual claim? Is it, they'll look at your billings, they'll look at your, how much do you work? Are you part-time? And really help make sure that, you're looked after. Long-term disability insurance covers sickness, accident, mental health. It really just means, a doctor has said you cannot do the duties of your job and the elimination period has been met. So 90 days or 120 days, whatever that period is, doctor says you cannot work after that period, you're considered to be on disability and your contract will pay you. So you'll get a monthly tax-free benefit until either you can go back to work or to an end date in your contract. And most of our clients, that's to age 65. So for young entrepreneurs, young professionals, it is long-term disability that they qualify for. If you're looking at a plan, if you have a plan, if you're looking at your group benefits and thinking, oh, is this good, is it bad? What you want to look for in terms of disability insurance, what's important to us is a non-cancelable product. And really that's RBC and Canada Life right now in the market. And what this means is if you put in place a contract at age 30, that they cannot cancel at age 40 or change the cost or alter it without your consent. So you can lower the cost, you can cancel, or you can lower the coverage amount, you can cancel the contract, but they cannot do that. So they cannot take it from you. Your workplace coverage is not like that. So if your employer decides we can't afford any of this anymore, we're done, or if you change employers or you're let go, then your coverage is going to go along with you. We really like contracts with partial and residual disability. And what that means is that you can't work to the extent that you were before. Maybe now you're working 50%, your income, your business income's gone down 50% as a direct correlation. Your billings, whatever it might be, is that you can apply to be on partial or residual disability, meaning you're getting a portion of your benefit. So you're still going to be hopefully earning the same amount, into your end pockets that you were before disability. Lots of great options in terms of that. Occupation classes. So any occupation versus own occupation. You're not going to get great terms on your group plan, but the personal contracts, you can get really excellent, small print. So something like own occupation for a lawyer, what that means is that if they cannot do their own occupation, so being a lawyer, so being say a litigation lawyer, then they can be considered to be on disability. So due to anxiety, their doctor says you can't go to court anymore, you can't do this. They're disabled, but they could say teach at the university and earn their disability benefit and then income on the side. Last couple just quick ones here. Waiver of premium during disability. What this means is when you're disabled, you don't have to pay your premium, which is great. And cost of living adjustment is something that is an optional rider on personal policies. And what that means is, if you go on disability at age 30 and your monthly benefit's 5,000 tax-free, while on disability, it will be indexed. So your benefit amount will be indexed along with inflation to a maximum, of course. However, that's really beneficial because if you're on disability for 35 years, 5,000 is not going to be the same 35 years later. You want that to grow along with the world. Okay. So critical illness insurance, long-term disability insurance. Many of our clients have both. Often one makes more sense just based on the vocation and or just the financial underwriting of it, something that we can assist with. The last short item I'm going to speak to is private health services plans. So this is not an insurance product. However, we get a lot of referrals from accountants around this area. And really the niche, I wouldn't say even necessarily the niche this fits, but business owners who are not quite ready for a group benefits plan, but do want something for their employees, or incorporated professionals, solopreneurs who are incorporated and have family medical expenses. Really the question is, would you rather pay for them personally after tax, or would you rather pay with corporate dollars and deduct them? 9 out of 10 times, people want to pay with corporate dollars and would love a deduction, so corporate deduction. So really how they work, it's not a insurance plan, it's not a benefits plan, so there's no premiums ongoing or anything like that. CRA requires one of these in place, so a private health services plan. People often call them health spending accounts too. They require one in place to be able to pay for personal health expenses out of your corporation outside of a group benefits plan. So really the easiest way to kind of discuss how this works in practice is we're talking about a higher income, because really what we're working on here is tax breaks and tax changes, and just trying to get, the best after tax dollars to pay for health expenses. So let's say your kids need braces or your spouse needs a hip surgery or whatever it might be. This is a big number. So 15,000 in annual medical expenses, health, medical, dental expenses. Without a PHSP, you're going to need to pull this money out of your corporation, whether it's salary or whatever it might be, and you're going to have to pay a bunch of tax on it to be able to get that money to then pay for your health expenses. Okay. So like anything, 15 grand of personal going to, the braces place and writing them a check, it's 15 grand at that point, but it costs you about, in a high tax bracket, about 25, 27 grand of income. So starting money, pre-tax income to actually get that 15 grand to pay for the braces. So yeah, it costed 15 grand, but really it's costing you about 27 grand. With a private health services plan, you're going to write your check for 15 grand. You're going to put it through the private health services plan. So the online portal, your corporation's then billed for the 15 grand. The company that we use, so we use Sear Financial to adjudicate these plans. They charge a 10% fee. So they'll bill 1,500 on top, and you're at a low tax rate as far as that money coming in. So the actual pre-tax money that you would need to earn via whatever you're doing in your world would be about 16 or 17 grand, somewhere in there, to then pay for that 15 grand of expenses. You're getting the deduction, you're getting all that. So in this case, you end up saving a decent amount on health expenses that you're already putting through. I know this is a different topic than the rest I've gone through, but it's one of those things that I always kind of like to mention as well. I would say my one takeaway from everything that I've seen or that I've talked about today, and just for the meetings and calls I'm in, when we were just kind of, having some small talk before jumping on this webinar, I just mentioned, I meet with so many business owners who say almost apologetically or embarrassed, or they're embarrassed that they didn't know anything about estate planning, corporate life insurance, critical estate, and they kind of feel a little sheepish about it. There's no reason that you should know a lot about something like this. Um, but the onus does end up on, on you to pick up the phone or whatever it might be. And what I hear a lot is that I should have done this sooner. And not just because now it's more expensive, because they're older, or whatever it might be. It's just, it's been one of those things where it hangs around, like getting your will done, getting your shareholder agreement signed, where if I had done this, I would have had this peace of mind and I would have been able to be in a better financial state if I just maybe done this a little bit sooner. How can you do that? So how can you kind of take that step? Give me a call, send me an email. Happy to help. We always just, we do a lot of, fact finding, things like that. One of the great things about meeting with us and why our clients love us is, unlike their accountants or lawyers, you don't get a big check at the end just for picking up the phone and talking to us. We always have the time, and we're just happy to learn about your business, your practice, your family, and just see if there is an area where we can maybe be of value. And I think that is all. That is my last kind of slide that I have there. So I'm not sure if anyone had any questions or anything like that, or any thoughts?
So sorry, I'm sharing with Milena because my headphones died, but I do have a question.
Yeah.
Are you said any time is a good time to start. So
Yeah.
if someone's been in business for a couple of years, they can make the call and start getting some of those things set up.
Yeah, and most of our clients, we aren't introduced at the startup phase. It's
Okay.
lots of times there's something that's happened, something's triggered for them to think, and lots of times it's just that someone mentioned them, hey, have you done this? Or we
Yeah.
say, hey, have you met with someone? But oftentimes it's maybe redoing the shareholders agreement, moving locations, or just that the business all of a sudden they have the cash flow and it's been on their minds for 5 years or 10 years. Where something's changed and now they think, okay, we need another look at this. Or a lot of our clients, it's their policies are renewing and things have changed and they just need a new look, and they don't necessarily think that the advisor they have really understands this market, and they want another set of eyes on it.
Okay, so a review of existing policies and such could be possible also.
Yeah, and we always start with a full fact finder, so we don't expect clients to come in saying, hey, here's where I'm lacking, is we have the shareholders agreement, but we have no insurance to fund it. We have clients that come in and say, hey, my friend said I need to meet with you guys like now.
Yeah.
So what, and I don't know anything about this, and we'll go through all that stuff. Do you have a shareholders agreement? What does it say? What is the business worth? What is your debt? What is, what do you own? What's your structure? We'll ask all those questions. Who's your family? What do you want to happen? What's the future of your business? All those types of things. And really that kind of just leads the way in terms of planning, recommendations, and everything like that.
Okay, cool. On the personal health spending account, or I probably got the
private health services
acronym wrong.
fund. Yeah.
So what does that, like, how many minimum or maximum employees do you need? Do you need employees?
Yeah, so an employee can be considered just a shareholder of the business if it's a solopreneur. Every employee needs to be, so there's no minimum. Every employee needs to be offered the plan, but you can set up different classes per employee. So your ownership class, shareholder class can essentially be an unlimited limit. So you can set it as 10 grand or whatever, and you can up it to unlimited. You need the money in your corporation to be able to pay for those expenses, of course. But you could then set up, so a lot of our clients, they'll say, the shareholders, the two owners will have 5 grand for each of their families, and their employees will give $1,000 a year. It's pay per use. So if employees use it, then they use it and they get reimbursed. So personally at the end of the year, so at the end of the year, the employees are square even for their health expenses up to that limit. It does
Yeah.
not count as an employee benefit, which is why this is important to have in place. So you can't just say, I can't just say, hey, thanks for the hard work. Here's a check for $1,000 for your kids' braces. At the end of the year, that would be taxable income for the employee. So this ensures that it ends up being a non-taxable benefit for your employees and a write-off for your business.
Okay. And in that regards, is there, I'm sorry if I'm monopolizing questions. If someone else has one, please step in. But in that plan, so are there restrictions as to what it covers in
So
terms?
no, they're pretty like, it's more lenient than what most people have on their actual group benefits plan. So,
Okay.
so for example, on a group benefits plan, you're going to be pretty limited when, when it comes to things like braces or anything like that.
New
I'll just
glasses or whatever, yeah.
Glasses, yeah, those are the big ones. And really, those are the types of things where, I mean, it makes sense because if you were going to be, putting those on your plan, people are going to max them out. So this will just take a quick second to pop up, but things that are eligible, acupuncture, chiro, dental. So, it's, things like dentures, naturopath, hospital visits. I had a client who used one this year for hip surgery, their spouse's hip surgery. So that was a large thing to put through. But everything that you would think of in a usual group benefits plan, because there is no, group benefits plans are, I'm just going to unshare my screen so my face is going to get really big. My apologies. Group benefits plans are insurance plans and they have to do with assessing the risk and the cost. So if you had, a business and everyone has glasses and you add vision on there, well, everyone's going to use the vision and then, it's going to get expensive. So a lot of group plans don't have that. So for us, in our business, we have a group plan, and then we have a private health services plan on top. So at the end of the year, our employees, including us, will say, okay, I was able to put through 70% of this or 60, all that balance could still then get put through your private health services plan. So it just helps you get, and as a business owner, it helps you just, just like anything, would you rather, you paid for your car or your business paid for your car? They're always going to say my business paid for my car.
Yeah.
Would you rather pay for your, whatever this might be, or would you rather your business? So it's a mechanism to have that and be above board with CRA, because otherwise you can't just, you can't just go and you can't bring your personal credit card to the, to the eyeglass place and say, or your corporate card and say, I'll just pay for this through my corp. That's not applicable.
No. Okay, cool. That sounds great.
Yeah.
If anyone else has any questions, please step in. Otherwise, I could keep asking, but I think we're good on that. Milena?
I don't have any questions, no, but also if someone does, they can unmute themselves, or if they don't feel comfortable, they can say it in the chat. But I included, if no one else has questions, I guess we can end it here, but I included a few events just in the chat box. So thank you to everybody who joined, and thank you again, Daniel. It was a very insightful presentation, so we appreciate you coming on here.